and thank you for joining us for another edition of the Market Commentators. My name is Andy Wilms. I'm the president and CEO of the Milwaukee Company, and joining me again this morning is Mike Wilms, who is our Chief Operating Officer and Compliance Officer. Good morning, Mike.
Andy, how are you?
I'm doing fine, thank you. A little bit tuckered out this morning. Had a long, early start to the day, so hopefully I'm able to keep up with you. But
well, and it sounded like there was a little bit of excitement on your drive down here with the accident that was on 43, right?
Yeah, I was coming down from Door County this morning, and it was quite a bad accident on the highway, so that slowed things down a bit too. But anyway, just a quick reminder for our audience that nothing in this podcast should be construed as investment advice, and that the views that Mike and I are going to express represent our personal opinions and not necessarily those of the Milwaukee Company. And with that out of the way, let's get started with our typical weekly recap or I should say, what's happened since we last spoke. And beginning with last week, it was, volatility reemerged last week as U.S. stocks fell for a second straight time, something that hadn't happened since April. Then again, a correction was kind of hardly unexpected given the $7 trillion increase in U.S. equity values over the last 5 months. More specifically, the Dow lost about 1.7%. The NASDAQ was up around 4%. The S&P was up about 2.5%. I'm sorry, down. I said that completely backwards. The Dow was down about 1.7%. The NASDAQ was down by S&P was down about 2.5%. I guess I'm so used to the markets going up. I got out of the habit of saying what goes up can't come down. But seriously, very little of the decline, though, seems to be attributable to worsening economic or financial conditions. For the most part, the economy seems pretty steadily improving since the lockdown, and the Fed has continued to pledge that it will maintain its loose monetary policy and keep interest rates below the inflation rate, which are both positives for the stock market. So I just think it was your typical classic case of just a little consolidation after a big rally. Bond yields ticked a little bit lower last week too, not much, but the Treasury slipped to 10-year Treasury slipped to just 67 basis points. And this week, the industrial average, both the Dow, the S&P, and the NASDAQ all were up on Monday after deals were announced on both the tech and pharma fronts, and they also got a boost by an announcement that Pfizer said it thought it could have its coronavirus available by year end. And lastly, yesterday, we saw that 8 of 11 of the market sectors that make up the S&P 500 rose. And that, even though the rise wasn't tremendous, that's important because usually when you have such a broad-based growth, that's typically associated with a more of a sustainable bull market. So there are some positives in that regard. And speaking of positives, are there any positives that you can report to us, Mike, on the COVID-19 pandemic situation?
Well, I think probably the top of the list, especially tying back with your comments about the markets and the economy, is that the OECD upgraded their forecast for the world economy to a little bit better outcome versus their June projection. In June, they had forecast a drop of 6% globally in GDP. They upped that to 4.5% earlier this week. So they're expecting a faster recovery in the U.S. and in Europe. And they now are actually projecting that China will actually expand very modestly in 2020. And a lot of this is driven by the continued massive research effort in search of vaccine and a therapeutic. As kind of a below the radar screen development, Eli Lilly announced yesterday that their antibody therapeutic had positive results relative to hospitalization, and the Pfizer vaccine potentially will be available, not for widespread distribution, but for the at-risk people, the hospital workers, and safety individuals, and so on and so forth. The overall rolling infection rate here in the United States has dropped. The 7-day average is down, as are the number of deaths. It's still obviously very scary at approximately 30,000 new infections a day, but at least it's trending in the right direction. That's down by over 50% from the high. And so we're moving in the right direction.
I heard, correct me if I'm wrong, but I think President Trump recently said that he thought that he would have the vaccine will be ready for limited distribution in 3 to 4 weeks. I don't know if you heard that assertion on his part, but do you think that's feasible, or do you think that might be just a little bit overly optimistic?
I'm not aware of anybody being that far along, but 3 or 4 weeks actually puts you to the middle of October, and that corresponds with earlier statements where the CDC had advised states to be ready for vaccine distribution by November 1st.
Okay, well, let's hope he's right. I know some people are greeting that with a little bit of skepticism and maybe a little bit looking at it a little bit of politicking, but you're right. There's been a lot of progress, and so God willing, that'll prove to be the case. So,
and the emergency use authorization from the FDA, that's to expedite and get into the population a vaccine as quickly as possible. But the risk is will people actually be comfortable taking it if it's rushed to market too soon? So there's pros and cons around all of that. But let's hope that there's a vaccine sooner than later that's well supported by data on safety and efficacy.
Would you take it if they said one was available in 3 weeks and they offered it to you? Would you take it?
Well, I've got a bad view on all of that. I got to die of something. and I'm already on borrowed time. I mean, you guys lost a lot of money when I made it to 40.
That's true enough. But I think I would be inclined to take it, but obviously you'd want to know more before doing so. But I think they've done just a bang up job on developing this. Let's hope it continues along that course.
Well, and there's so many different tracks. There's 3 main types of vaccines in development, you might be able to take more than one to assure immunity. So there's just a lot going on.
Yeah, there sure is. And I just will mention, in the midst of all this, it's very important not to forget about the importance of getting your flu shot and for the shot for the traditional flu. And that, October is generally thought of as the ideal time to do it. But any time now, I guess our viewers would benefit from getting out there and getting that flu shot.
Absolutely.
All right. Well, you talked a little bit about China's economy and how well it's doing and how it's recovering faster than most people expected. A recent survey from the Wall Street Journal of a group of prominent economists said that they also thought the U.S. economy and labor market are recovering from the coronavirus downturn faster than they had expected. But that said, U.S. jobless claims continue to remain at a worrisome pace. Last week, weekly jobless claims totaled 884,000 versus an estimate of 850. So we're once again above our S's, and continuing claims, which I know you pay particularly close attention to, were 13.4 million, which was an increase of 93,000 from the previous week. So the labor situation still is a cause for the concern, and one of the reasons there's been such a push to come up with a stimulus plan that both the Senate and the House and the President can all agree to. The Senate failed last week to advance their most recent plan, which was a lot smaller than what the Democrats are pushing for. Now there's been some talk about a new $1.5 trillion plan. I think we were talking about that a little bit. Why don't you fill us in on that?
Well, and I guess it's really kind of, there's been so many numbers thrown about. I mean, the House passed version for a fifth stimulus going back to the summer was at $3.5 trillion initially. Right now, Nancy Pelosi and Chuck Schumer have reduced their demand or their suggested program to $2.2 trillion. What was proposed in the Senate was a $650 billion program to essentially restore the unemployment benefits and provide a small level of support to state and local governments. And the payroll protection program would have been extended. There is a group of 50 evenly split Democrat and Republican House of Representative members that have formed the Problem Solvers Caucus. They're the group that put forward the $1.5 billion proposal here on Tuesday, yesterday. It's going to be interesting to see. Nancy Pelosi is now talking about keeping the House in session until something's actually passed. If they don't accomplish some type of legislation for additional support between now and the election, there's a high probability that you wouldn't see any additional government stimulus and help to the people that need it until after the inauguration in 2021.
Well, it's kind of a contradiction of terms, isn't it? When you say politicians and problem solvers caucus. I mean,
I didn't come up with the name.
Causing caucus might be a little more apropos, but so you don't see. Do you think this is going to be resolved before the election? Do you think they're going to pass something? I mean,
I think that there's enough people, and especially the members of both the House and the Senate, that are in jeopardy of re-election. There's going to be a push to get something done. There's a clear need for additional support. The Federal Reserve can't do it on its own. There needs to be something done on the fiscal front. Clearly, the consumer spending numbers were down here slightly that were announced earlier today for August after the the federal unemployment insurance at $600 a week expired. Mm-hmm. So I'm hopeful. Let's put it that way.
Well, you mentioned the Fed, and of course today is Fed Day, and the Federal Open Market Committee is going to meet, and it's almost certain that it's going to keep the benchmark rate unchanged when it announces its decision at 2 p.m. What's going to be interesting to me is that it should also be accompanied by new economic forecasts, and those are expected to show that they'll keep interest rates close to zero through 2023. That's correct. That's the
and I think that's the discussion point that the market's most focused on, because essentially that's extending the low interest rate environment for an additional year.
Right. I think the big problem that some people are having with the stimulus program, and I consider myself one of them, is that they aren't targeted enough to really focus on the people that need it need the help the most. I mean, with all the talk of a so-called V-shaped recovery, it's now seems that U.S. economy is beginning to look more like a K, where pockets of the economy are recovering at an accelerated rate. That's the line of the K going up, and others that are going to be in a decline for a much longer period. That's the line going down, and of the K. And when we did the first round of stimulus, there was no attempt to try and focus the help on those industries that make up the bottom line of the K. It was just pervasive, didn't matter what you did or how you were impacted. Everybody was getting all this, all the benefit, and that's what made it so expensive. So I think if Congress can do a good job of targeting this to the people who really need it, it has a much better chance of passing. And, let's hope that that's what ends up happening,
Well, the proposal with the Problem Solvers Caucus, the 1.5 trillion, does include another round of the $1,200 payments to everyone without any specificity. Struggling with that one here this morning.
Yeah.
And but it does have a cap on unemployment insurance at the federal level, starting out at $450 a week, and then after 8 weeks, going to the lower of 100% of your previous earnings, or a cap of $600. So they're trying to address some of those concepts in the proposed new legislation.
Well, let's hope that they're successful. I mean, some people don't think we need to worry about it, right? The government can spend what it wants, and there's no consequences for it. And one of the statistics I see that is being pointed to kind of suggest that we don't have to worry as much about the deficit is that interest payments on the federal budget declined about 10% in the first 11 months of the fiscal year when America was running its biggest deficit ever. And so they're saying, over the next few years, with interest rates being so terribly low, servicing the debt will be cheaper than at any time in the past half century, when it's measured against the size of the economy. That's according to the CBO. But then again, so the question becomes, can we stop worrying about the deficit and not be so careful about the way the stimulus is structured? And there's considerable disagreement on the subject, and a lot of smart people on both sides of the coin here. I think that we do need to still worry about the deficit. Call me old-fashioned, but I'm very concerned about it still. And just in that regard, if you look at 2019, the federal deficit was about $984 billion, or 4.6% of gross domestic product. And we all know there were people very concerned about a deficit at that level. But if we look at what the CBO is projecting for April of 2020, they projected that this year's deficit will be $3.7 trillion, or 17.9% of GDP. And it could be even larger, of course, if this next round of stimulus gets passed, or if Congress approves even more tax cuts or additional spending, because of the pandemic. So I think we do need to worry about the deficit, even though right now it's not costing as much to service because of low rates, because low rates are not likely to remain low forever. And the Fed has been the one forcing these rates down, and that's been to the detriment of savers, pension funds, and financial institutions. They can only take it for so long. We've said this in the past. More money in the circulation is inflationary when demand picks up. Because you'll have more dollars chasing goods, and the value of the dollar has already fallen in response to the increase in the money supply. And lastly, the reason I'm concerned about this is because the greater the deficits are now, the less ammunition you're going to have in the future to fight future crises. So for all those reasons, I think the deficit is still a very big problem. We got to be careful about how much stimulus we continue to inject into the economy. How about what's your view?
Well, I mean, the canary in the coal mine here was late last week, early this week. Three of the large Asian economies, India, South Korea, their government bond auctions experienced weak investor demand. And where India had been expecting to price their 10-year security at 6%, it actually, to clear the amount for sale, they needed to price at 640. So if you think about the massive level of deficit spending, if you go back to the Clinton administration and the bond vigilantes, as we were running a large deficit, the institutional investor community backed away from bidding at the Treasury auctions, and they had a hard time placing the debt.
Wow.
And if you go to the August auctions in the U.S. Treasury market, where you saw the 10-year U.S. Treasury, the yield was, I can't say spike, but it almost sounds like a spike. If we're at 665 or 666 today, the 10-year was at 75 basis points last at the end of August,
right,
as there weren't enough buyers to step in and take down $38 billion worth of newly issued 10-year notes.
Right, and so far the Treasury's response to that has been, well, we'll buy them.
Well, no, it's the Federal Reserve.
I'm sorry, I misspoke. The Federal Reserve, thank you. The Federal Reserve's response has been, don't worry, we'll buy them from you.
Well, that didn't work so well. I mean, one of the other countries in Asia here, Indonesia, just simply had their central bank step in and buy the unabsorbed new issuance, and everybody freaked out, and their currency fell out of bed because of the direct monetization of the newly issued debt.
That's the problem. And I read somewhere this last week that 40% of the 10-year T-bills are owned by our central bank or other central banks right now. So
and that's correct, and that's and there'll be a where on the yield curve discussion for Treasury on where they're going to issue. Especially with the drop in interest rates, they're trying to move out and do more of the 10, 20, and 30-year issuance. And that, as people become concerned about interest rates, that's where the investor interest is going to disappear the quickest.
Exactly. Well, and we've tried to stay away from some of those longer term debts and at the Milwaukee company here for quite some time now, for fear that, because of course, if interest rates do go up, the bonds you own will be worth less. Well, and
you don't want to sit with something underwater for 30 years waiting for it to mature at par.
Yeah, that's a long time for old folks like you and me. Another thing is kind of interesting to me, and I'd like to talk a little bit about, if you're so inclined, is that there's been a lot of discussion about the S&P and NASDAQ indexes becoming overly concentrated, and we've talked about this in the past. But I think it's such an important point that I think it's worth elaborating a little bit on, because the ETFs that track the S&P and the NASDAQ are a huge part of many investors' portfolios, especially as a result of the much more popular passive investment strategies that people are starting to use, investing in passively managed funds instead of actively ones. But so both the indexes, the S&P and NASDAQ, have gotten heavily weighted towards just a handful of stocks, because they are market weighted. The amount that you invest, the index invests in each stock that makes up the index, depends on the value of that company. So as the value of the stock of that company goes up, it becomes a larger and larger share of the index. And this really exposes investors to concentration risk, which is usually what you're trying to avoid when you invest in an index fund. they're highly concentrated. And so the unique problems of any one of these mega sized members aren't diversified away by all of the other companies in the index. So that brings us to the question of, is there a better alternative? And I don't know if you want to express an opinion on that, but to me, I think maybe it's time to start looking at equal weighted ETFs and ETFs tracking the S&P and the NASDAQ as a part of the portfolio.
If you look at just focusing on Apple, for instance, Apple's up 57% year to date and is the largest market cap security in the world. It's been approximately $2 trillion. Apple alone's market cap exceeds the entire composite of the Russell 2000 small cap universe. So, I mean, when you think about that, that's really pretty amazing. And if you look at the S&P being up 4.7 or 4.8% year to date, if you took Apple out of the equation, that would reduce the performance of the S&P by 50%. So, there's just a huge overweight with Apple's inclusion and with how well the company has done. And it actually caused, when they did the stock split here a couple of weeks ago, a complete rejiggering of the Dow Jones Industrial Average because as a price-weighted index, they needed to make several other adjustments, including removing ExxonMobil from the index after having been in the Dow for 98 years.
Right, but the S&P and the NASDAQ 100 are not price weighted.
They're market cap weighted, exactly.
And so, the point being that, when you look at this, about a quarter of the S&P 500 is invested in just these 5 companies, Facebook, Amazon, Apple, Alphabet, / Google, and Microsoft. So what you're really doing is making a very big bet on those companies when you buy the S&P 500 index, which is not what it's intended for, right? Its intended use is to provide a diversified exposure to the overall large cap sector of the U.S. stock market.
Exactly.
And my point is, if you want to invest in those 5 companies, then don't buy SPY to do it, right? Don't buy triple Qs to do it because you're bringing along all these others. If you really think that's the place to be, then buy those stocks. But if you're looking for diversification, then the alternative would be an equal weighted ETF where they invest the same amount in every company that is included in the index, regardless of the amount or the value of the company, I should say. So those same 5 companies that are over 25% of the S&P 500 index would only be 1.25% of an equal weighted S&P 500 index fund. And so if you're looking for diversification, and you want, the other problem is that SPY, because of these high valuations, has gotten expensive. And while the equal weight version, for example, RSP is one of the equal weighted S&P 500 funds, is still pricey from a historical standpoint. It's a lot cheaper than SPY. Now, as you pointed out, that concentration in those 5 companies has really benefited people who are invested in SPY because they've taken it up much, much higher. So, from the last year or so, it's been the fact that you're in a market weighted index has rewarded you. But I tend to think at some point, mean reversion is going to kick in and you'll see some of these other companies that haven't done as well relative to these huge ones kick in. So rotating maybe part of your investment into SPY or part of your investment into triple Qs, which is a symbol for an index ETF that tracks the NASDAQ 100, rotating some of that money into a more equal weighted ETF might make some sense for those who are looking for diversification and are trying to manage risk and really want to have a passive portfolio, more passive portfolio passive investment vehicle.
Well, and I think that's right. I mean, if you from the concept of diversification, and to your comments about rotation, you're starting to see early indications that there is a sector rotation taking place back into the financials and the industrials, which are two of the 5 groups of 11 industries in the S&P that are still down on the year. That equal weight S&P 500 ETF, the RSP is still down 4.4% on the year relative to the S&P itself, the market cap weighted SPY being up 4.8. So I mean, you get a broader diversification and equal performance if there is some level of sector rotation out of those massive tech names into some of the other recovering segments of the economy.
And that's something we've been seeing in the last few days in the market.
Correct.
So
can't argue with you there as much as I'd like to.
Well, I better call it quits then before I give you something else to argue with me about. And it looks like we're just about to the end of our time anyway. So on that happy note, I'm going to say thank you very much, Mike, for joining me today in this discussion. I would like to thank also all of our listeners for joining us, our viewers, as the case may be. And I want to remind everybody that it's important that they not act on anything that they've heard in this podcast until they've discussed it with a qualified financial professional who is familiar with your personal investment objectives, personal situation and investment objectives. All right, with that said, Mike, I'm going to wish you a great day and we'll talk to you soon.
Have a great day, everyone. Thank you.
Thank you.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.